Top of the morning to you, and welcome to our newest episode of Capital Markets Quickie from MVP Mind Value Partners. The U.S. stock market finished slightly higher last week as U.S. investors continued to hope for a fiscal stimulus package. European equities, on the other hand, finished slightly negative due to COVID-19 cases rising at an alarming rate. My name is Endrit Cela, coming at you from Frankfurt, Germany, Europe's financial hub and home to the ECB. Let's take a closer look at what moved the markets this week. Stocks fluctuated between positive and negative territory last week, reflecting a tug-of-war between rising concerns and encouraging economic data. Weakness in the stock market came mainly from the continued stalemate in stimulus talks, along with the recent rise in COVID-19 cases and the additional worries over the reopening of the economy. Markets did find a glimpse of hope from a positive U.S. retail sales report that showed consumer spending rose strongly in September despite the lack of renewed aid from Washington, which signals some resiliency to the economic recovery. Either that or everyone is just stocking up on their reserves, preparing for another lockdown. Now, the fundamental long-term outlook for the economy in the U.S. and worldwide for that matter remains positive. But as last week demonstrated, policy support and the path of the virus, along with the discovery of an effective vaccine, will be the key drivers in the weeks and months ahead. Let's take a closer look at the economic outlook. Experts believe the economy has likely formed a durable bottom. So that is the good news, we've hit the bottom. You don't hear that every day. However, the pace at which the economy and growth will recover is likely to slow down from here on out, and the return to pre-pandemic levels will obviously take some time. Now, despite uncertainties, a gradual improvement in the labor market along with low interest rates and hopefully more fiscal stimulus should help sustain the economic recovery into 2021. Following a record GDP decline in the second quarter of 2020, the economy experienced an initial V-shaped recovery and has recovered almost 2/3 of its pandemic-induced losses. As fiscal relief is gradually phased out and the initial reopening boost fades, this strong rebound, which we've seen so far, is likely to give way to slower but sustained growth going into 2021. Yet unemployment remains high and further employment gains are definitely needed to support the handoff from stimulus to growth. And of course to help drive consumer spending, which we all know makes up the lion's share of the economy in the US. And according to recent surveys, consumers are in better shape compared with past recessions such as 2008, 2009, with personal saving rates elevated and debt ratios low. It almost sounds too good to be true. However, the pandemic has created a two-track economy as major industries either remain capacity constrained or experience weak demand. For example, as of August, consumer spending in goods was 5% above the February peak, but spending on the far bigger category of services such as restaurants, hotels, and bars remained 7% below peak. Basically, that means consumers are drinking their beer at home instead of at the bar. And this uneven recovery is preventing the economy from reaching its full potential, and it is likely to persist until a vaccine arrives. And that takes us to the economic outlook for the stock market. With support from economic growth, corporate earnings rebounding, and interest rates remaining low for years to come, the longer-term outlook for stocks remains positive. In the near term, however, you should expect volatility to remain elevated, and the reasons I believe are well known, and I do not need to repeat myself like a broken record. This severe recession which we had was short-lived, and that helped corporate earnings hold up better than expected, even though they did take a sizable hit, declining by 35% in the second quarter of 2020. However, corporate earnings are expected to improve in the latter part of 2020 and then rebound strongly in 2021. And that, of course, is stock market positive. And on that positive note, ladies and gentlemen, we conclude today's episode of Capital Markets Quickie. To all of you listening from every corner of the globe, I wish you all the best and stay tuned for our next episode on Sunday, October the 25th.